Welcome, Gary.
Thank you.
Good to have you. We're sitting in a hot spot in Dubai right now, where the world seems to have shifted its focus. And fortunately, this is our first podcast in the middle and the thick of it.
Indeed.
So it's good to have you.
Yeah.
And as CIO for Sapiens, I would love to understand, your insights. What exactly are you looking at, and how in this world do we find alpha?
Yeah, it's great to be on this call and chatting about markets. I don't think in my whole career have I seen a phase of the markets where everything seems to be going well, but it doesn't feel like that. And that comes back to the point you've made about alpha versus beta. The markets are doing well, but from the alpha side, the poor fund managers are really struggling. So, and it's always a profound problem when, your fund is up 20%, but someone tells you you're failing because the benchmark is up 30%. But that's what's been happening, particularly in equities, and maybe, one space that has been the most most profoundly difficult to keep up with the benchmarks has been in emerging markets, where we've had this massive outperformance of two markets, Korea and Taiwan. And if you hadn't had the exposure there and you were deeply skeptical about tech, you would be underperforming by tens of percentage points. It's that bad. So, yes, we have great markets, but seeking the alpha in the right places is so important.
So, for an institutional investor who would want to understand an emerging market such as South Korea or Taiwan, who doesn't necessarily have that inclination or knowledge, how would you suggest someone get a hold of that information?
Yeah, I mean, the best performing managers we've seen in this block have been local. So the local guys knew how profound the changes were. So they come in two forms, in particular in Korea and then latterly into Taiwan. In Korea, you had the big political change, and then you had the significant corporate change. Now, anywhere else in the world, you just wouldn't notice that because Korea is so far away. It wouldn't have been on your radar screen. All of the big news out of Asia in terms of big change was coming from Japan, where we were seeing those reforms and corporate restructuring going that we'd never seen before. And then Korea pops up. Now, the problem in Korea for an international manager is it's such a tiny fraction of the index. You say, I don't really need this. I've got my China and my India. But it has done so well that it's become a very substantial part of the returns of the index. So if you were investing, I always say in those small markets, always have an active manager and have a local manager. International guys sitting in a New York or a London are never going to be able to capture the change of mood and almost living that mood by being in the country every day of the week.
Any preference for an asset class within these emerging markets?
Um, I think in terms of, in fact, the easiest one to do at the moment is emerging market debt. It's been a very, very consistent outperformance of emerging market debt managers. And there you've got probably something with a greater longevity of management and a greater probably longevity of many of the themes, which means that you can go back and look for patterns. Whereas in the emerging market equity space, we've had an event which is like once every 25 years. So the emerging market debt managers have done very well, both in terms of their currency choices, whether it's hedged or unhedged, and secondly, in terms of their positioning across the yield curve. So, and I think that's going to continue. I think there's some great stories in emerging countries at the moment because there's a profound change happened. We used to think of them as the kind of the weak spot amongst asset classes where the countries weren't that well managed, where the indebtedness kind of got to a peak at some point and you go, oh, I've got to get out. There's much more consistency, well managed, the balance sheets of countries under good control, and still a premium of yield to exploit as a manager.
Pivoting more towards the developed side, when we look at the US, we're at all-time highs, barring, of course, yesterday while markets were slightly down given high inflation numbers at around 3.8%. The expectation amongst quite a few is that rates will be hiked, given the fact that inflation is coming back with full force. Is that your expectation? And as a result, how would you position yourselves for fixed income at first and also generally across the market?
Yeah, I think the problem for the US equity market, and this again goes back to the problem for active managers, you make a call on the US economy, it is utterly irrelevant. Irrelevant. Because the concentration of the S&P 500 or any of the manners in which you would invest in the market is so focused on one sector that other things don't matter. So to put a kind of a concept on that, we've got consumer confidence at an all-time low. We've got the Nasdaq at an all-time high, and the gap between those, again, never seen before. We look at employment growth across the United States. It's just not happening. It's only happening in the healthcare sector, not in the main economy. We've got interest rates, as you say, that may be going up rather than down. And we've got obviously the political challenges with many people feeling very disaffected. So if you put all those things down a piece of paper and didn't put the country on it, you'd say, I want to be out of this market. But it is a massive outperformer, and it's all coming in one sector, and it's coming in just about 30 stocks out of the S&P 500. So if you look since 2024, the earnings forecast for 470 companies have hardly changed. The companies in that last 30 have made up all of the massive upgrades to S&P 500 corporate profits. So it's a very, very, very narrow focus. And you do worry that, we've got a huge amount of liquidity in that US economy. Interest rates have been low. People are saying, well, bonds at 3 or 4% don't interest me. So they're going into the equity market. And you've seen that particularly with retail investors. But it's been such a narrow focus. If ever there is a day when there's a piece of news out there, which has to be of some scale, but some piece of news in the tech sector that makes people feel, I think I need to take my profits, then we could see a very sizable down leg. So the momentum is with the tech, the momentum is with those companies, the momentum is seemingly with the US market, but it's not for active managers. They just can't make money relative to the index, given that narrow focus.
And lastly, with respect to gold, what is your thought process, given the fact that gold has been having quite a run, and recently due to the Iran war, it has come down since. Recently, India just imposed a tariff on all gold imports as a result of improving their deficit. How would you play the asset class for precious metals?
Yeah, I think you still need your gold. And I think after its quiet period, it's probably a time to go back in. Now, people say, well, look, it went up a long way and it's come back a bit. It may not be the regular, consistent performer that I'm looking for an asset that's an insurance policy inside your portfolio. But I think that goes back to the tech story. Tech has taken some money away from gold because, almost like a few months ago, we were buying gold at that time, like the way people buy tech today, almost blindly. And tech came along and said, no, actually, we want some of the action and we've got a good story. And money migrated across the tech sector. I think with the issues of war, with the issues of inflation, I don't think tech protects you. So I think if you haven't yet got a significant insurance policy inside your portfolio, something that goes up when everything falls, then you need to have more gold. And I don't think it's fanciful to say that as a part of your wealth planning, it should be closer to 10% than 2%. If you look in the United States today, the average holding is less than 2% in brokerage accounts. So if those investors are all in tech today, so I'm out and I need to protect my wealth, I think gold can have another profound run.
And what is your thought process on EM equity, given the fact that we are in the second month, more than the second month of the Iran war? A lot of countries that are dependent on Gulf oil have shown signs of simmering. How do you position your emerging market portfolio at the moment?
Yeah, it's a tough one. I think there's been a surprise that markets have done so well, and a surprise that people don't talk about exactly the points you're making so often. And I think it comes back to Taco Trump that the assumption is, well, I've got this negative view, but he might change his mind tomorrow, so I stay engaged in the markets. So in a sense, Trump has been good for the markets despite the bad news that we've had in the background, but it can't continue forever. At some point, we are going to have the overwhelming stories that we don't have enough fertilizer and therefore our food prices are going up substantially, that we can't do things because we can't find a flight. Doesn't matter how much money you've got in the world, you can't take the flight because the flight doesn't run because there isn't the fuel there in order to make that plane allow that plane to take off. So those shortages, when they do start to show up, I think are going to be very challenging, and particularly in the emerging markets. The only caveat to that is that a number of them started this crisis with good levels of inventories of fuel. And they're also good at probably telling the population we've got a problem, like Modi's done, and say, okay, can you stop doing something so that we can live for longer with these challenges? So I don't think necessarily that the emerging market's the place that you would kind of dump in fear of what's happening at the moment. I'm going to be more concerned with interest rates rising in Europe and their GDP coming down by 2 percentage points, being in recession, which is still a large market. So the selling pressure may be on other parts rather than necessarily the broad emerging markets.
Given the ongoing developments worldwide, from the developed market all the way to the emerging markets across Europe, how would you position your global portfolio?
I think it depends on time frame. For example, look, these may sound crazy, but what would you do today when you've seen Korea do so well and India do so badly? It's screaming at you to buy India and sell Korea. So I think you've got to think wisely here about taking profits on things that have done particularly well and going back into the old economy. There will be a wave of higher bond yields, which will see a sell-off, and that's the time to be buying back into bonds, because I'm assuming central bankers won't change their spots. They will allow for the inflation to go up and then they'll increase interest rates. But at some point, they're going to be targeting those low inflation rates again. And therefore, yields of 5 or 6% will be a bargain for the next 10 years. So the buying opportunities will come, but you should use the selling opportunities today in assets that have done profoundly well and have gone way beyond the valuation metrics that you would normally expect.
Okay. Lovely. Thank you, Gary. Appreciate your time. And we look forward to this again next week.
Thank you very much, Niven.